Banks, some of the most influential institutions in today's world. We trust them with our money and to that extent our livelihood. Yet how many of us really understand how they operate? Three main types of banks exist today: retail banks, commercial banks, and investment banks. For the purposes of our explanation, I'm going to bundle commercial banks with retail banks. Whilst commercial banks cater for businesses and retail banks cater for individuals, their activities are broadly the same. Now, as long as investment banks kept their distance from retail banks, any misfortune within investment banks could be relatively contained. Unfortunately, such common sense did not appear to grace our political and economic leaders. The United States had maintained separation between retail banks and investment banks since the Great Depression of the 1930s. However, investment banks grew in the 1980s, and so did their influence. As a result, the United States overturned the requirement for separation between retail and investment banks in the late 80s, at which point the line between retail and investment banks blurred. Incidentally, the United Kingdom, along with other G7 nations, did not have this requirement for separation to begin with. This is just one of many realities built into society which have been designed to exploit the population. In fact, the banking and monetary system is nothing more than a tool by which to control the masses by controlling their buying power. This statement is not made lightly, but to understand it, we need to understand how retail and investment banks operate. Let's go over the basics of retail or commercial banking. I'm going to use pounds to explain how retail banks work. Feel free to substitute pounds for dollars, euros, or any other currency. The concept is the same all over the world. Let's say that you've saved £1,000. Too much money for the cookie jar, right? Where do you naturally take it? To the bank. More specifically, a retail bank. Retail banks are the kind of banks you and I are familiar with. They have branches, ATMs, they send you statements, and so on. You deposit £1,000 into your local retail bank. As a reward for giving them your money, they pay you interest. For example, 3%. This means if you leave your money with them for a year and don't make any withdrawals or deposits, they'll give you £30 interest. How does the bank pay for the £30 interest they're giving you? They lend your money to someone who wants to borrow it. Someone walks into your local branch and asks the bank for £1,000. The bank decides whether to lend them the money or not based on whether they think they'll pay it back. If they think they can, then they'll give them the money and charge them an interest rate which is higher than that they're paying you for your money. 6% in this example. That means if the borrower doesn't repay any of the £1,000 back, the principal, then over the course of a year they will be charged with 6% interest, £60. So the bank takes the borrower's £60, pays you the £30 they owe you in interest, takes away any expenses they may have, and keeps the rest as profit. As long as banks lent their money wisely, the system more or less worked. Now, investment banks are a different beast altogether. For many years, investment bankers were living the high life at our expense. Multi-million-pound bonuses for doing nothing other than making profit. They didn't create anything. They didn't provide a community service. They simply made raw profit at the expense of others. Well, at least they paid tax on the money they made, assuming no overseas tax havens were involved. So, an investment bank makes its money by raising capital for its clients, advising on activities such as mergers and acquisitions, and by trading in bonds, currencies, debt and stocks. The trading aspect is what I want to focus on here. An investment bank will use different strategies to trade bonds, currencies, debt and stock based on what they believe they will do in the future. Let's take an example of investing in debt, more specifically, collateralized debt obligations, CDOs. After all, CDOs are what caused the credit crunch of 2008 and 2009. A CDO is essentially a block of debt. For example, £1 million CDO could be made up of 10 £100,000 mortgages with the respective homes as collateral against the loans. CDOs were created by investment banks trying to flog off yet another product, and funny enough, other investment banks started buying them. This incestuous cycle is what made the credit crunch so devastating. Like a house of cards, it only took the collapse of one bank to bring about the collapse of the others. Now, let's say that an investment bank buys a £1 million CDO. The interest the CDO will return on the debt will give the bank an annual income of 5%, that is £50,000 a year. Let's say that the CDO is rated AAA a seemingly sound investment. The bank will buy as much of this debt as possible with the expectation that it will yield 5% interest and that the assets against the debt rise in value. If the £1,000,000 debt was made up of 10 £100,000 mortgages, they would expect the interest from the mortgages paid by the 10 homeowners to bring in income and the value of the homes to rise in value, giving them further security if any of the homeowners didn't keep up repayments and they had to sell their home. Now, in their never-ending quest for profit, banks realized there was a way to make even more profit from the very same deal. By buying debt with borrowed money instead of their own, they could minimize their outlay and amplify their profit. Using other people's money to buy securities such as debt is also known as leveraging. Let's say the bank wants to buy the CDO by borrowing the £1,000,000 from a lender. The lender the bank borrowed the money from agrees to give them £800,000 at 3% interest as long as they stump up the other £200,000. This £200,000 is known as collateral. If the value of the CDO drops, let's say from £1,000,000 to £900,000, then this will eat into the collateral before eating into the loan. That way, the lender's money is protected by the collateral, a cash buffer. If the loss becomes greater than £200,000, then the lender will issue a margin call. They are basically saying that the drop in the CDO value has wiped out the bank's collateral, so the bank has two options, either selling the CDO, cutting their losses and paying the lender back the money they borrowed, or finding more money for collateral to keep the lender happy, keeping the CDO and hoping it will rise again. So why would our trusty investment bank take such a risk? To increase their profit. Let's say the bank buys the £1,000,000 CDO and it gives them £50,000 a year, 5% interest. Remember, they need to pay their lender 3% a year on the £800,000 they borrowed. That's £24,000. That means they're left with £26,000 profit a year. Now, they've only put up £200,000 of their own money, meaning £200,000 made them £26,000. That's 13% profit, more than 2.5 times more profit than the 5% they stood to make had they stumped up the entire £1,000,000. Now, what if these AAA CDOs weren't exactly AAA? It turns out that these high-security CDOs actually had lots of risky debt packaged into them. Lenders don't like to use the word risky though, they prefer subprime. Investment banks packaged up risky debt with safe debt, packaged it all as AAA, and basically made the risky debt vanish into thin air. It's no different to a baker switching half of your fresh bread rolls with the rolls they baked last week and claiming they were all baked today. If your baker did that, then they would be charged with fraud. The only charges bankers saw were those on their corporate cards. Back to our example. What if some of the debt in a CDO went bad? What if something happened to one of the homeowners? Let's call him Bob. Bob lost his job and couldn't make his repayments. The bank he took the mortgage from manages to sell his home, but instead of selling it for £100,000, they only get £80,000. The £20,000 they lost is written off as bad debt, and the value of the CDO drops. Now, let's say that 2 more people were in the same situation as Bob, so that 3 of the 10 mortgages were written off with the properties being sold for less than the amount of the debt. All of a sudden, the value of the CDO plummets as it's evident that the income from interest will not be there and that selling the underlying assets, the homes, will not generate enough money to pay back the debt. Let's say the value of the CDO drops to £800,000. The lender of the £800,000 would issue a margin call on the loan our trusty investment bank took out. Either the investment bank came up with another chunk of collateral, or they sold off the CDO at its current price and paid back the lender. Not wanting to cut their losses, banks tried to raise more collateral. How did they do this? Well, in some instances, they tried to call in loans they gave to other banks. But the other banks were in exactly the same position, looking to find money themselves to pay off the CDOs that they owned. Some banks simply couldn't come up with the cash, and they were so leveraged that they simply shut shop. That is what happened to Lehman Brothers. Overnight, one of the most reputable investment banks in the world announced bankruptcy, but there was worse to come. Lehman Brothers was a pure investment bank,